In this video, we're continuing our Strategy Blueprint series, where we explore how different trader and investor types can incorporate seasonality into their decision making. And today we're focusing on long-term investors. Investors who are allocating capital for months or years, not hours or days. And the interesting thing is that seasonality can often be even more useful for investors than it is for short-term traders. So let's start by defining the investor type. Now, a long-term investor typically builds positions over months or even years. They're focusing on portfolio growth and capital preservation. Their allocations are across equities, commodities, and other assets. And the long-term investor is less concerned with day-to-day volatility. But even long-term investors face an important challenge. When should capital be deployed? Even the best investment ideas can suffer if capital is allocated during historically weak periods. And this is where seasonality becomes extremely valuable. For long-term investors, seasonality isn't about predicting the short-term price movements. Instead, it provides historical context for capital deployment, and using SeasonX, investors can analyse how markets have historically behaved across different months of the year. So, for example, one widely recognised example is the tendency for equity markets to strengthen into the final quarter of the year. Take, for example, the S&P 500. And we look at this in the final quarter of the year, take it from 11th of October through to the 31st of December. Over the last 25 years, you can see that we've seen an average return of over 4%, an 84% winning trade percentage in the S&P 500, a steady cumulative profit. And this strong performance is often linked to institutional positioning into year end, increased consumer spending expectations, the so-called Santa Claus rally, and then portfolio rebalancing by large funds. So for long-term investors, identifying strong periods is incredibly helpful, and it helps investors recognize as well when markets have historically struggled. So taking a look at the seasonals, we can see that seasonality is not only about identifying strong periods, it also helps investors recognize when markets have historically struggled. A well-known Wall Street saying is the so-called saying, sell in May and go away. And historically, equity markets such as the S&P 500 have tended to experience a much weaker average performance between the months of May and September. Now, this doesn't mean that markets always fall during this period, but historically, this part of the year has often been characterized by lowering trading activity, fewer corporate catalysts, and occasional higher volatility. So, for instance, if you took a look here from sort of the middle of May through to the middle of September, you can see that the S&P 500 has gained an average return of 1.39%, inferior to the over 4% gain that we see in the final quarter of the year. So seasonality can reveal recurring behaviours, not in only indices, but across lots of different asset classes. Another good example is gold. Now, gold historically shows a tendency to strengthen between the end of December through to the new year. And this seasonal pattern is often linked to increased physical buying ahead of the Chinese Lunar New Year. Also, around the middle of December, you often get the Federal Reserve's last interest meeting, has often happened by the 20th of December, 19th of December. And you just tend to see this strong seasonal pattern for gold. Average return 6.30%, a steady rising cumulative profit, 76% winning trade percentage. So seasonality is not only good for recognizing advantageous times to allocate capital, it's also a powerful tool for risk management. Even long-term investors need to manage periods where markets historically experience, higher volatility, larger drawdowns, or slower performance. And seasonal analysis can reveal when markets have historically experienced these type of conditions, and you can see across the range of the entire year weaker and stronger seasonal periods. So another practical benefit of seasonality for investors is entry optimization. Rather than just deploying capital all at once, investors can use seasonality to phase their investments over time, improve average entry prices. Even small improvements in entry timing can significantly enhance long-term portfolio performances. So the key takeaway from this strategy blueprint is simple. Seasonality is not just a trading tool. For long-term investors, it can be a portfolio management framework. And by understanding recurring market patterns, such as the tendency for equities to strengthen into year end, historically weaker periods during the summer months, seasonal demand cycles in commodities like gold, and there are many other seasonal patterns like this for you to discover, investors can make more informed decisions about when to allocate capital and how to manage risk. And if you're managing long-term investments, I encourage you to explore these seasonal patterns using Seasonax and test them with your own investment process. Because successful investing isn't just about what you buy, it's also about when you buy it.